Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Thanks for joining me. It's George Masri, and on this episode, I interviewed Pierre-Paul Turgeon, I'm going to say it the French way, who is an apartment building investor out in Alberta. He's a former CMHC multi-family underwriter and a full-time multi-family investor. He's got a portfolio of over 160 doors. He's analyzed hundreds of apartment building deals, being a former CMHC underwriter, so he's got a lot of experience with this. And on this episode, we talked about why he's able to increase rents for the first time in 6 years, how inflation has impacted oil and gas and the general Alberta real estate market, the cap rates, price per door for apartment buildings in Edmonton and Calgary. We also talked about 4 key risk factors during an acquisition, what you should be aware of, why evictions are easier in Alberta, and then the potential risk of rent control based on the upcoming election. So there you go. Another part of this is that Pierre-Paul is hosting a workshop, which will be happening on November 4th, coming up very soon. If you guys are interested, I posted a link in the description where you can register. And then also just a reminder to make sure to leave us a 5-star review on the Apple Podcast platform so we can continue to grow, share a good message out there, inspire people to invest. And if you guys want to get involved in some investment options, make sure to reach out. So go to welloff.ca, contact me there, and then you can set up a call, and that way we can talk about your goals and how we can help you reach your goals. There you go. Enjoy the episode. All right, I'm here with Pierre-Paul, who's been a guest on the show before. Thank you for joining me once again.
My pleasure to be here, George. Thank you for having me.
Yeah, for sure. I thought you'd be a great person to speak to. For those that don't know, you are a multi-unit investor. You own multiple apartment buildings. You have a CMHC underwriting background. So I'm just kind of recapping because we already touched on this in the past, but how are you doing out there? I know you said you were getting some snow. How are things looking out in the West End?
Well, like I said, from a snow perspective, very good. We're expecting somewhere between 10 and 30 centimeters starting tonight. So I'm a skier with season's passes to the Rockies. So I'm really happy about that. From a business point of view, as many people know, from a multifamily investing point of view, it's been a rough patch here in Alberta for the last 6 years with the price of oil. But the wind is finally turning around for good, for the better. So from that perspective, actually today I'm giving my first rent increases to my properties in 6 years, George. Wow. So it's been, like, when I say a rough patch, we don't have tight landlord-tenant legislation like you guys have in Ontario. Mm-hmm. But we've had, and of course, everybody's been crapping all over the oil and gas industry. But George, that too is changing. Anyway, that's a different topic. I don't want to start on a rant first off.
All right, fair enough.
But allow me to say that people are realizing there is such a thing as energy security, and it's quite important. So, so the numbers for Alberta look up. I'm very bullish, and I'm starting to raise more capital to make more acquisitions. So that's how bullish I am.
Well, that's the interesting thing, because obviously we're I would think we're technically in a recession at this point. And
absolutely are.
Yeah. So we're in a recession. We're seeing these higher interest rates, but we're also seeing inflation and higher gas prices. So does that, what are you guys experiencing out there? Are you seeing that, maybe single family homes and like residential home prices are falling, but because rents are increasing, does that mean that commercial properties are increasing in value?
That certainly is the expectation. And let me caution you, as you know, George, I'm out east quite a lot, or a lot less since COVID, obviously. But, I was there speaking in May at the multifamily conference. I'll be there again in 2023 that Seth Ferguson's organizing. But the point is, I know the Ontario market. I follow it very well. And things are much different than what you're experiencing. There is a correction of single home prices in Ontario. Vancouver somewhat as well, but most Ontario, because the market was overheated, as you know. We're not experiencing that in the singles market The reason being, it's been an economy that's been down for 6 years, and so we haven't had overpricing of assets in Alberta. Our rents are below, are some of the lowest, and house prices as well. So, which helps with my positivism, if you will, in that Canada's gotta get like 450,000 new immigrants a year is the target that the federal government has. And you know what the housing costs in Ontario. So if you look, and it's as soon as I'm done with this, I'm going to be shooting a video here in my studio and have some of these stats. More people are moving from Ontario, speaking of which, to Alberta for those reasons. Great job opportunities with the price of oil now being at a good point, and we haven't seen the end of that. You were saying gas prices have increased. They have, but then they came down a little bit. So that's partly why the inflation came down a little bit. But this is far from over time. You can expect gas prices to continue to go up. So in a nutshell, it's important for people that are listening to your show, George, to understand our reality in Alberta is much different than what is being experienced in Ontario, Quebec, or Lower Mainland British Columbia, in a nutshell. So, Anyway, I don't want to, ask me questions because, if you let me talk, I'll talk.
Okay. Well, just something that I thought of as you were speaking is, are electric vehicles a threat to your economy, in your opinion?
That's a joke, George. Sorry, I don't mean to be sarcastic. It's a joke. So many issues. So let me backtrack a little bit. This is kind of stuff I follow a lot. Like I'm talking on a daily basis, energy transition and all that, and these various sources. Because if there's one thing I did not know when I started my career as a full-time multifamily investor, when I left CMHC and all of that, if there's one risk factor I failed to underwrite to assess properly, and I would say that CMHC also failed to do that, and some of those organizations that perhaps you belong to that kept telling us, buy in Alberta, who shall remain nameless, but you can read between the lines. They were all of us, they were all encouraging us to buy in Alberta. So the one risk factor I did not know, did not consider enough, was how dependent Alberta is on oil and gas. Mm-hmm. So since then, the last 6 years, I make a very big point of reading on that, multiple sources to have a better idea of that risk factor. Hence the reason now I'm very bullish on it. But we've been hijacked, and I'll be very blunt, and a lot of people out there are not going to agree. I don't care. I've got gray hair. I'm allowed to say, and I can support my thoughts. We've been hijacked by eco-terrorists across Canada. Unfortunately, our Prime Minister in Canada supported that. But realistically speaking, the technology to enable us to, all of us, drive EVs, electrical vehicles, is nowhere near, is not in the near future. Okay, we don't have we don't have enough batteries yet. We need to get those minerals, those special earth minerals to build these batteries, supply of which a lot of it comes from Asia. Needless to say that the relationship with China is not so great these days. We have some of it in Canada, but it takes time to develop that. We have a vast country. We don't have charging stations that go far. I was just telling, we're expecting 20, 30 centimeters of snow. So this is nowhere near a threat. And we have been hijacked by eco-terrorists in the last 6 years that took over the agenda and make us believe that this transition can be done overnight. Look at what's going on in Europe. It's a disaster. People are going to freeze in Europe, George, this winter. There's people going back to national forest in Germany to cut trees down. They're reopening coal plants and nuclear reactors. It's bad. So this has all been, we need to make this transition. Don't get me wrong. Like in a couple of weeks, I'll be hunting. I'm a mountain guy. I'm outdoors all year round, literally. Okay, I camp, I fish, you name it, I do it all. So I'm very much pro-environment, but we can't pretend that we have all the means and the wherewithal to affect an energy transition by 2030, like some of the ridiculous targets have been set. So no, I don't buy into that BS, and like it's not based in science. It's just based on hot air promises at COP 25 or whatever those COPs are, and next one, COP27. So yeah, nowhere near. But at the same time, I do support making that transition, but let's use science-based kind of technology to set more reasonable targets. Long-winded answer, but you're touching a very sensitive point. Like I said, I had to educate myself in these matters, and that's my opinion and based in facts.
Yeah, I was more so thinking maybe like in, I don't know, 30 to 50 years, if that transition happened, what would happen to Alberta's economy and to your portfolio and all that?
Well, so I think you used the proper time frame. We're talking decades before we get there. But Alberta finally has understood that it needs to diversify. So from that point of view, I'm not worried. And speaking of which, in terms of diversification, even Alberta is becoming and is already a leader in making that transition to greener technologies. The oil and gas companies have created a consortium. Edmonton's been dubbed the hydrogen capital of Canada. And for all these areas of enabling us to make that transition, carbon capture and all that, it'll cost a lot of money, research and development money to do these things. And Alberta is at the forefront of all of that, is Canada's leader. Mm-hmm. And something that I want to point out to you as well, even carbon emissions from the oil and gas sector in the last decade have decreased by 30%. You don't hear that very often. It's not very media catching because it goes against the agenda of energy transition, but or the eco-terrorists, the agenda of eco-terrorists, if I may call them. But so I'm not worried about it. But the other reason as well, George, this is a trend. Like I said, I'm just about to shoot a video after I'm done with this interview. What's going on demographically in Canada? We are moving away from a society where everybody owns a home. My 3 young children have now 3 young adults. Very likely they'll be renters. So what you want to do is plan for the future. And I know I'm not a slumlord. I upgrade my units to higher finishes, not high end, but way above, somewhere between middle end and high end, if you will, because again, our country is moving towards a society of renters, so we need to cater to those people's needs. Mm-hmm. So I'm very optimistic in that regards. And by then, 30 years from now, it still makes sense to be in the multifamily investing business. It always will. That's all I can say because people need shelter always. So
sure. What kind of numbers are you looking at right now in your market? Are you investing in like downtown Alberta, or where are you exactly?
So I tend to stick to what I know. My portfolio is in Edmonton, and I'm looking at.
That's what I meant.
Yeah.
Edmonton.
Got it. So although I live closer to Calgary, I'm just 20 minutes west of Calgary. I stick to what I know best, and it's Edmonton. The reason being that it's more diversified as an economy compared to Calgary's economy, and that's what I know. That's what the portfolio that I know. Yeah. So in terms of valuations, and I don't think I answered your question. Values have been fairly flat, but where there's the most growth is in Alberta. So we have folks that you've had on your show recently, friends of mine as well, that are from GTA investing out here. So that tells you something, right? That there's I'm not the only one that sees a lot of potential. So that's an ongoing trend of investors either coming from lower mainland British Columbia or GTA and elsewhere in the country coming to Alberta to invest in multifamily property. So that will put pressure on values, in my opinion. And again, the good news here in Alberta is we don't have a restrictive landlord-tenant legislation as you have in Ontario. Mm-hmm. Basically, you can increase your rents once a year by whatever the market can bear. Hence, like I said, today is the first time in 6 years that I'm finally giving rental increases. Yeah. But we have some catch up to do because operating expenses have kept increasing in the meantime. So
now, okay, let's dive into this a little bit. Let's say you have a property that you've just acquired, which is outdated. The units are all outdated. They need a lot of work. You have some issues there. You have squatters, whatever. What would you do from that point in order to turn these units around? What would be your process?
Squatters, that's a pretty extreme situation. I've never had that.
Well, let's say you don't have like a bunch of squatters. Maybe there's a couple tenants that aren't paying their rent, and then the other
Yeah,
units are all just outdated and whatnot.
yeah. Well, that could be a gem in the rough, right? That's where there's what you call a value add project, Georgia, and all of us always look for that kind of project. Then it's a matter of it's always a matter once you find a deal, right? And that's clearly, as you know, this is what I teach as well. I don't know if you mentioned that, but I do have a workshop.
Yeah.
That's what a 3-day workshop where I teach this and an on version, online version of that course. You need to look at the risk factors very clearly every time you look at a deal. There's 4 key risk factors in every real estate deal. Property risk factor, so that's physical condition of the asset, the market risk, right, and valuation, and the investor or borrower risk factor. Now I'm speaking a little bit like as a former underwriter, but these are the 4 key risk factors that you want to look at. So you just got to take each one on its own, and then arrive at a valuation that makes sense based on the condition, based on where the property is located in the marketplace. Is that a Class A kind of neighborhood, or Class B, C, right? So you make price adjustments in that regard. But in Alberta, these value add projects, and like I said, one of your guests recently on your show, right, is very aggressive doing this, following this particular strategy here in Alberta. The good news is, if it's a complete gutter, then obviously you can charge whatever you think the market rents can be at that time. And I've done that several times. But our legislation here is more flexible. We don't have, in terms of the tenant landlord tribunal, we don't have the long delays that you guys have. So if we need to evict tenants here, it's a much faster process, as long as you can justify that. And again, the rents can be adjusted to market average and whatever the market can bear in terms of rents at that particular moment. So I definitely look for projects like that. They require more work on one's part, but with the right team, the right property manager, the right contractor in Alberta, and appreciate in Alberta, the housing stock is a lot younger, newer than what it is out east, right? It's not uncommon in Ontario to find 100-year-old multifamily properties and stuff like that. For us, they tend to be built more in the 60s, 70s. So it's a younger, housing stock, if you will, out in Alberta.
Okay. And I know you answered part of the question, but if I wanted to get into like more detail here, just for my own curiosity.
Sure.
So yeah, you take over this building. You've got these old units that are occupied by tenants. You want the tenants to move so that you can renovate the building. What would you do in that situation? Are you filing with the board to evict for renovations? What would be that procedure?
Yeah, that's certainly something that you can do. To be honest with you, I don't handle this stuff. It's my property manager. So I wouldn't pretend to be the most knowledgeable when it comes to the landlord-tenant legislations in Alberta. You could do that. I'm assuming you can do that. So don't take my word for it, because literally, George, I don't pay somebody. The one thing I would probably do, though, which I can do and I have done, is also, if the tenant is unwilling to move, well, you just increase the rents by quite a lot, and there's nobody to stop you from doing that.
Yeah,
that's often a strategy that I've used for undesired tenants, basically. So that's what you would do. That absolutely. But I think I know where you're coming from. You're coming from Ontario, where this is very difficult.
Yeah.
In Alberta, this is not as difficult to do that. Nowhere near. The landlord-tenant legislation is a lot more permissive than it is in Ontario, to be honest with you.
Well, the thing is, so I know last year when I was talking to a lot of investors on the podcast, a lot of them were going out to Nova Scotia because they didn't have rent control and whatnot. And then next thing you know, they put in rent control. So all these investors that were going for that reason got stuck. Do you think that could apply to Edmonton, Calgary, to these areas, or is that something you feel like wouldn't happen for a while?
The risk is always there. We have a new premier that hasn't run into a general election yet. I think it's not scheduled until next next spring. But there is the NDP, Rachel Notley, NDP, and I suspect if she were to come on board, that she may well implement more restrictive landlord-tenant legislation. So unfortunately, it's part of the business, so there's a risk. The UCP, United Conservative Party, I'm not superly impressed. So there is a chance that we might have next year an NDP government, and it would not be surprising if they did bring that on, which again, it would be a shame. We have a severe housing crisis in this country. Mm-hmm. And one of the issues is exactly that overly restrictive landlord-tenant legislation. So developers are not interested in building more. Obviously, rising costs. The biggest problem being also with the municipalities. They're not granting enough building permits. So those tenant landlord legislations, when they're overly restrictive, they hamper the market. They don't help. They don't help it. So that's. But there's a risk.
Yeah. I guess there's always that risk, but I mean, for the time being, it seems like a very, very good option for certain investors, especially those out of province investors that are going in, pouring all this money into these buildings, upgrading them, and then increasing their value in either refinancing or selling the building.
Yeah, but like I said, George, I did my mea culpa. I'm an Easterner that's been in Alberta for 20 years, but even when my butt was still sitting in the cubicle at CMHC, if people come from out of province, they do need to understand the nature of this market, which is at this point very reliant on oil and gas industry. Mm-hmm. Okay, we are diversifying. But that's certainly a factor that one needs to take into account when coming to Alberta. How diversification is not something that just happens overnight, so there's a risk there. But overall, I'm very optimistic about Alberta for sure.
So what would be not that you necessarily are an economist or whatnot, but I'm sure you have lots of knowledge on this. What would be the factors that would impact oil prices? Like what we've seen the last couple of years is very low interest rates, borrowing rates, which caused inflation to increase, which then caused oil prices to increase. Would there be other factors that would impact oil prices?
Well, the supply of it. So obviously now with I do follow this stuff quite a bit. The geopolitical situation now, as you know, Europe doesn't want to buy oil from Russia anymore. Mm-hmm. So that's a major factor that's going to have an impact on oil. What caused the price of oil to go down significantly the last 10, 15 years was what we call fracking, right? We do some here in Alberta, but mostly in the United States, which allowed the United States to become almost self-sufficient or certainly produce huge amounts of oil. The problem with that is, first of all, demand for oil is not decreasing, despite, again, whatever claims that people are making that we can make this transition for decades, George. I have time to live a great life with my portfolio and pass away before I'm expecting to have an issue with my portfolio because it's located in oil country or oil province in Canada. So it's going to take a while. But what you need to understand about fracking, they drill a well and they pump water to bring the oil to come up to the surface. Those wells, they get depleted at a rate of about 30% a year. So within 4 or 5 years, you got no more oil. So you got to drill another one. Okay. And I'm going to summarize this a little bit for you, but the game, and the musical chair kind of game's been able to go on because, Wall Street was financing that. But you need to understand that the supply of oil is not necessarily that great, other than, of course, in the Middle Eastern countries, right? Saudi Arabia, not like that. But the price of oil came down because we had lots of it. We have an oversupply. Now we're seeing the opposite, phenomenon going on, mainly because also we don't want to rely on the oil from Russia. So over time, I'm very, very confident. But I would say in the next 20, 30 years, But beyond that, of course, we have to come up with new technologies, and we've got to move away from fossil fuels. There's no doubt about it. But that's developing economies do need a lot of oil still. They don't have electricity, not everywhere. Like there's a lot of challenges. So that's why energy security needs to be taken into account into this dialogue, and it wasn't before. So now we're paying the price for it.
Okay. All right. Why don't we go back just to touch on a little bit of the market now, I guess in Edmonton, because that's where you invest. What kind of cap rates are you seeing at this point? What would be maybe price per door or that kind of thing, if you can just share with us some of the numbers?
Yeah. So, like, as you know, real estate is very specific. So I can talk, let's say if you take a city like whether it's Calgary or Edmonton, both cities have a river that kind of separates the north from the south. Calgary, it's the Bow River, and in Edmonton, it's the North Saskatchewan River. So you can always find different pockets of markets. But to give you an idea, let's say in Edmonton, which I own one building, it's the prime area. It's the University of Alberta area where my daughter lives. She actually lives in one of my buildings. Obviously, values there would be significantly higher because it's a more desirable area. We're looking at the kind of values that I'm seeing these days, $130,000 a door, something like that, right?
Mm-hmm.
Or more, 140, 150, depends how close you are to the university, etc. If, on the other hand, you pick a neighborhood further north or north of the river, not necessarily too close to downtown, because close to downtown, it would be similar values I just mentioned, south of the river in the university area. Mm-hmm. But you these days, the kind of listings that I see, you can get a decent property for $105,000, $114,000 a door easily. So in terms of cap rates, that translates into something like 5.25, maybe a little bit lower, depending on the condition, the year, the age of the property. But yeah, it's they're higher cap rates than in your neck of the woods for sure, or again Vancouver. So there's some decent values here for sure in Alberta. There's some decent projects if you look properly. Yeah, if you look closely.
Very cool. Yeah, that's definitely the rates are higher than we see here in Ontario and most of our like most of the GTA, I should say.
Yeah, for sure.
Yeah, and so yeah, you're getting. I mean, aside from the oil and gas industry, are there any other major markets in Edmonton? What would people generally do if they're living downtown?
In terms of what? I'm not sure if I followed your question.
Yeah, so my question was a little unclear. But aside from being involved in oil and gas, would there be any other major industries that people would be involved in?
Okay. In terms of the economy, yeah, and that's one of the reasons why I also choose to invest in Edmonton. The economy compared to Calgary's economy is more diversified.
Yeah.
So all the manufacturing sector to support the oil and gas industry is in Edmonton. It's obviously our provincial capital, so accordingly, you have all the civil servants that feed, the government and that work for the government and so on. So, as an economy, it is way more diversified than Calgary.
Yeah.
Calgary, however, values are higher, just because that's where the head offices of the oil and gas companies are. Mm-hmm. They tend to prefer to be here in Calgary versus Edmonton. The reason being that we're closer to the mountains. We're less than an hour from the mountains. So people that have a similar lifestyle to mine, we ski, all that stuff. So or we hike. So, but the Edmonton, the Calgary market also has a lot less apartment buildings. The housing stock is a lot smaller in Calgary compared to Edmonton. So your price point is significantly higher. For example, Calgary, an apartment building, you'll pay easily over a couple $100,000 a door, generally speaking, right? Mm-hmm. And so if you remember, I said, depending where in Edmonton, you could get something, if you're lucky, 105 a door, 115 seems to be where listings are at right now. South of the river would be more like in the 130, 40, $50,000. Calgary, you're looking at much more, add 10, no more than 10, 20, 30, $40,000 more and above the $200,000 mark in Calgary, because there are less apartment buildings to invest in.
Mm-hmm.
So,
okay. Got it. I mean, there's some good stuff here. Maybe just to touch on the recent changes in the market and how it's impacted your business.
Yeah.
So,
Yeah.
obviously, prices have come down in general. People are more afraid, they're spending less, but rents have gone up. So, tell me about some of the adjustments you've seen. Have you seen any changes in the values of your buildings and the appraisals and that kind of thing?
Yeah, like I said, today is the first day, November 1st, where I'm giving the first rental increase to my properties, my 6 properties in the last 6 years. In the last 6 years, as you can easily imagine, operating expenses have continued to go up, including the carbon tax, including property taxes, utilities, and all of that. Therefore, my net operating income, which is the driver of values for apartment buildings of 5 or more units. So people need to understand that the NOI is not your net cash flow, but it's your income before you service your debt. And obviously my NOI according has been going down. It's an interesting question, which I teach I put a lot of emphasis on that. Even in recent weeks, I've been teaching a masterclass on cap rates, the magic of cap rates revealed. Actually, there's one more. I think your podcast is probably going to be broadcasted later, but I talk about that. Most of us, we talk about cap rates because it is the income capitalization approach to arrive at a value, right? So the NOI is the driver of the value. You take your NOI that the property generates divided by the average cap rate for comparable properties in your marketplace, you'll arrive at a value. Mm-hmm. There are this is called an approach, income capitalization approach. It's not called the science of the income capitalization, right? Meaning that there are flaws. And what we've experienced in Alberta, technically speaking, a lot of people's NOIs, including mine, have come down. You would expect values to crash, but they have not. They were fair. They might have come down on paper technically, but if you're not selling, the values are not moving. You don't have comps. So some people have been desperate to sell their assets. That's a great deal for somebody else that comes in and buys it at a lower valuation. I'm not one of those. I'm a long-term holder. So in that regard, it's been an interesting. So values have not crashed, and it literally, like I said, it's one of the slides that I have in my presentation. If you look at valuations on average, they've been fairly stable, and because people see what I'm seeing, others, including a former guest that you've had on this show recently, are coming out from a GTA to invest in Alberta. They see what I see, and they're bullish. So values have not crashed at all. So it goes to show that even though there's such a thing as the income capitalization approach, and you take the NOI divided by the average cap rate, you're supposed to arrive at a value. It's not a perfect approach. That's what I mean to say. So it's one of those things, But sure. Values have not crashed significantly. I think there was another component to your question, George. You remember it? Was that it? The answer?
Just I think I've like maybe what adjustments have you had to make?
And you were talking about adjustments in the industry. Yes. So this is an important question. That I really like that question. Despite the fact that my NOIs, I speak generally for all my properties, were reduced, I continue to, the kind of adjustment I made is to continue to inject money into my properties to bring them up to a higher standard, because people don't want shaggy carpets anymore. People want nice vinyl flooring like I have in my own house. And so making sure that the units are catering to what tenants now want. Okay. So looking to the future. So that's sort of what the kind of adjustment I've been making. And now, like I said, we're finally entering into a great phase with lots of potential for Alberta. I am ready. My units will be the first to get rented out and at the top dollars in the marketplace. Those that didn't see this coming, their units will remain vacant for a lot longer than my units. My properties are in good condition. So that's one adjustment. In terms of other adjustments, in recent years, I think people may or may not know, but there's 2 ways of financing apartment buildings, right? There's a conventional way, which is not CMHC insured financing. And then there's CMHC insured financing. Conventional lenders don't publish their guidelines, their underwriting guidelines. So when they get a deal, they will assess it, risk it, and based on their perception of the risk factors, the 4 key risk factors that I was mentioning earlier, and they will give you whatever loan amount they feel that they're comfortable giving you, okay? CMHC, and I have them right here, CMHC has published guidelines, right? So you kind of have a better idea of what to expect from CMHC, but at the same time, when CMHC gets a deal, even though they have published guidelines, based on the risking of the application, the financing application, they will lower the loan amount, do whatever they want. All the lenders and commercial lenders included have that prerogative from that perspective. People need to know from a CMHC perspective, there's been a couple of policy changes that were quite earth-shattering, is almost an understatement. One of them in 2020, when the COVID began, when the use of equity takeout funds is restricted now. In the past, guys like me and the large REITs, by the way, Boardwalk and all the REITs, used to refinance buildings, take some of that money, and do whatever they wanted to do with the money, including returning capital or dividends to investors. Now, this is not allowed for CMHC insured financing. So that was a bit of a damper on my business model and that of a lot of people. You're allowed to use those equity takeout funds to build another apartment building, to pay out a construction loan, or to increase the energy efficiency of the building, and a few things like that. But so that's one big change. There's another big change for CMHC that people need to know about. It was last year, January of 2021. If you buy an apartment building between 5 and 24 units, 5 and 24 units, you need to submit an appraisal to CMHC in support of your value. I think this is a positive thing, although it's an extra expense, right? $2,500, maybe $3,000. But at least CMHC has the market value. The market value for the asset is supported, because in the past, some of your listeners may know, CMHC has always been very harsh on value. They would always use the value, the lending value they would use tended to be below that of market value. So hopefully now, so those are a couple of changes in the industry that we all have to adjust to. The other big thing that CMHC has come out with is CMHC's MLI Select. I'm not sure if you've heard about that or not. So it's to promote the construction of housing or retrofitting. So there's 3 kind of buckets. The 3 social outcomes that they're pursuing is greater affordability, then it's environmental friendly, and then accessibility. So obviously, you can get, it's worth for people to look at, but don't go crazy, I would say, because there's also some downside to this program. But basically, let me pick one example: affordability. If you can either retrofit some of your units and charge rents below the medium income for your market area, and CMHC has a chart for all the medium income for renters in your area, and you keep a certain number of these units affordable for, let's say, 10 years. I think it can go up to 20 years. Then you get some benefits, namely the mortgage premium is a lot lower. It can be, if you get 100 points, let's say the highest, I think the premium is 1.1%, right? Versus 4.5%, the highest premium bracket for CMHC insured financing. You can also get longer amortizations, George, up to 50 years if you get the maximum points.
Yeah.
And a lower DCR as well. So it's well worth looking into it. Same idea if it's for accessibility or, like I said, environmentally friendly buildings. You benefit from these other advantages: longer amortizations, lower premium, and so on. So it's worth it. So, but it's mortgage agents and brokers are super busy processing these kind of applications. This program came out in March of this year. So it's called CMHC's MLI Select. So I encourage people to look at it.
All right. Thank you for sharing a bit about that program. I see behind you there, you've got a couple binders with some information. So it looks like you've got some sort of course going on. Do you want to tell us a bit about it?
Yeah, so people can always find me, George, at multifamilyinvestingcanada.com. We got a workshop, depending how your podcast or when your podcast is broadcasted. But yeah, I've got my 3-day Canadian Multifamily Investing Blueprint workshop this coming Friday, November 4th to the 6th. Time and time again, people rated over 9 out of 10 because the people that follow exactly the blueprint, George, to become very quickly successful. People can go to my website and check out the testimonials, but it's experiential, George. For example, I was just talking about CMHC's MLI Select, which is a brand new product that came out in March. So what I do is I'm going to explain to people in greater detail how the program works. And then we use case studies in class. We crunch the numbers. I've got a very simple spreadsheet, same one that I used to use at CMHC. And within class, we analyze a bunch of case studies so that by the time people leave the workshop, they know what they're doing. They know what financing looks like. I've got a bunch of charts over the years that I create the entire investment process, an offer to purchase flow chart with the various documents you got to get, a flow chart describing the various financing strategies based on the financing circumstances of your deal, and all the underwriting guidelines, CMHC insured financing versus conventional financing. You get a beautiful, workbook that you can take notes. So, I have a few copycats in the country teaching multifamily investing. They were students of mine. It is what it is. I guess it's a sign of success when people start emulating you, but nobody can beat me in terms of having prepared this workshop to this level of detail. When I speak, I present different viewpoints. As you know, I used to be, so I wear different hats, literally, right? When I speak as a former underwriter, I wear this hat. Of course, I'm first and foremost now an investor. So when I present a perspective, a different opinion as an investor, I wear this hat. And of course, I used to be a lawyer that did real estate. So I'll express my viewpoint as a former lawyer as well. So I give people a lot of perspective and hands-on experience to be very successful. And like I said, year after year, the students rated over 9 out of 10. And the people that follow the blueprint, they're becoming successful. So yeah, people are interested. If not, we'll have a sale, a Black Friday sale for the on-demand course, and you get a lifetime access to the on-demand course. Plus, I answer your questions personally in the on-demand course. And in 2023, I'm coming with a brand new version, shot in 4K with all this fancy equipment that I have around me here. So the course does deliver. So if people are willing, George, like I said, as soon as we're done this interview, I'm going to be shooting a video about why, despite all the mayhem and geopolitical situation, high inflation, increasing interest rates, investing in apartment buildings, if you have, like me, a long-term investment horizon, it's one of the best asset classes. Apartment buildings are known to be resilient, counter-cyclical, meaning when the going gets tough, they continue to perform very well. During COVID, during the Great Recession of 2009, I've seen it time and time again. Great asset class to be invested in. So people want to learn how to do it. But I just want to warn people, George, this investing in larger apartment buildings is the big leagues of real estate investing. Tire kickers not allowed. Don't bother taking my course or writing offers. You're going to be written off by the stakeholders, the realtors, right off the bat. But if you're serious, you're committed, not just interested in investing in apartment buildings, come and attend my workshop. Mm-hmm. They're the same tools that I use myself, due diligence checklists, inspection checklists, and I keep coming up with new tools to help people. So thank you for giving me a chance to make a pitch about it. But yeah, if you can broadcast this, November 4th is starting. So I encourage you to sign up very soon.
Sounds good. There's a bit of homework. Where do people go to find out about this workshop?
Yeah, at support at multifamilyinvestingcanada.com. But I'll send you a link right after we hang up, George. If you want to add it, that'd be great. I'll do that. So,
okay, sounds good. Great. Thanks for sharing all this. It's always good to learn about different markets and learn about other provinces and what's happening there. So I appreciate your time, and we'll definitely have this out before the weekend so that people can go out and register for your workshop.
Very grateful, George. I appreciate it. You be well. Take care.
Okay, you as well. Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.